Imagine buying a house today and locking in a monthly payment that is much lower than you expected. Sounds great, right? But what if I told you that same home is going to take you half a century to pay off, and you'll end up paying as much as twice the interest that you traditionally would? Now, that is what is expected and what we're seeing with the proposed 50-year mortgage. Now, I am Dennis, a certified financial counselor, and today we're going to dive into the pros, the cons, the pitfalls, what it means for home buyers, and what it could also mean when it comes to these future home buyers. So a bit of context to this, they are looking to extending the 30-year mortgage into a 50-year mortgage. This is being floated in a lot of political circles. Donald Trump has remarked, you are going to pay less per month, but you will pay a much greater amount over an extended amount of time, having that 50-year mortgage. Now, one analyst estimated that looking at the median home price, moving from a 30-year to a 50-year mortgage would only reduce your payment about $120 a month, and yet it will double the total interest paid over those additional 20 years over the life of the loan, which is kind of crazy. So as an illustration, suppose you buy a home at your current median price. Right now in the United States, it is $415,000, and you choose a 30-year term, which is what we see right now. If you switch that 30-year term to a 50-year term, your payments are going to drop from $2,288 to $2,022, assuming the exact same interest rate, but the interest you're going to pay over those additional 20 years will be an astronomical increase. Now, why is this being discussed? Because housing affordability is a real challenge. When we have the combination of higher home prices, higher mortgage rates, very tight supply, the 50-year term is being pitched as one of the many tools they're looking at to lower the monthly burden. But of course, it is not coming without a huge cost. So let's start with the good. When we look at the potential and what could we see with a 50-year mortgage, first one and the big one that is really driving a lot of people, it is going to be a lower monthly payment. Because you're spreading the same principal, let's say that $415K, over more years, the payments every single month are going to be much smaller. This could make homeownership a lot more accessible for individuals, including people that are on a tighter budget, or even those individuals that are first-time home buyers. Now, of course, this is going to improve cash flow, really the flexibility with a much lower outcome, around, again, $120. The borrower could have a little more leeway or prioritize other things such as emergency funds, kids' education, retirement planning, having a lot more stress on the budget. Now, of course, in markets where home prices are very high, incomes are constrained, the term could give individuals breathing room when it comes to the mortgage itself. This could also potentially increase home access with a lower barrier, really a monthly barrier into entry. More homes might be stepping into, or rather owning, than renting in the entirety, or people could upgrade that otherwise could not afford the home that they're looking to go into. And of course, some proponents argue that it could bolster the house market price and drive prices even higher with economic activity, because now these people that were priced out of certain homes at 30 years can now afford those homes at 50 years. And this is also the long-term horizon aligning with really a lifetime of ownership and really home ownership. So some people, including myself, stay in their home for decades. If one views it as a very long-term asset, perhaps a long-term 50-year play might make sense. If you intend to keep a property for 30, 40, even 50 years, the extended term might align with the horizon that you plan to live within that home. Now, on the flip side, there are some serious drawbacks when it comes to this 50-year mortgage. And the first one, and the big focus, much higher total cost. Because you're paying the interest over an extended amount of time, looking at those 50 years, the cumulative interest will become enormous. When you look at a 30-year loan, you might have a $403,000 in interest on a $348,000 loan. Think about that for a minute. So on a 30-year mortgage, you are going to have $403,000 on interest on a $348,000 loan at 6%. Crazy. So you are paying $403 in interest on top of the $348 you're paying. When we look at the 50-year version of this, you are looking at $751,000 in interest on a $348,000 house, which is kind of crazy. Now, the big worry here is extending from a 30 to a 50. you will over double the dollar amount of interest paid in the extended amount of time, which means you have lower monthly payments, but you're paying far longer for that life of the loan. Now, of course, the big caveat to this, equity builds very slow. Because your payments are stretched over 50 years, large portion of the payment, probably the first almost 20 years, a majority of that is going to be going to interest rather than principal, meaning to build any equity or have the ability to take equity out of a home, it is not going to exist for an extended amount of time. They are forecasting on a 50-year term, you might not even accumulate $100,000 in equity until you're into year 30, where the 30-year loan, it's about 12 to 13 years, excluding appreciation in there. So again, when you start looking at that, you're extending the amount of equity you're building from the regular 12 to 13 years on a 30-year mortgage, going to until year 30 to get that same $100,000. Slow equity will, of course, reduce financial flexibility. You'll be locked in a house. You'll have less cushion. You'll have less ability to refinance, reallocate, or relocate, and doing home equity loans will be completely out of the question. Now, of course, the debt horizon and the risk of being in debt for life. If you take out a 50-year mortgage at the age of 40, you're going to own the house or still be making payments at the age of 90, or if you even live longer. Now, this raises a lot of really big red flags when it comes to Social Security, retirement, legacy planning, inheritance. All of those would be gone because of that extended amount of time. Critiques are arguing this is going to be the trap of home ownership, and it is only going to benefit the financial institutions. Now, of course, when we start looking at the combination of this, going to a 50-year loan, higher rates are more likely on a 50-year loan. When we look at longer term, it is going to carry a lot more risk for the lenders. Economic cycles, inflation, job changes, defaults. That means the 50-year loan is going to be considerably higher of an interest rate for that extended amount of time than we're traditionally seeing on a 30-year loan. That is going to reduce the monthly savings, also increase costs overall. The earlier same as rate is super optimistic. Again, as it carries more risk for lenders, there is going to be a higher rate with this. And of course, it doesn't address the root cause. Houses are not affordable. Many experts really look at the big issue of the supply constraints that we're seeing. Rezoning, regulation, construction costs, stretching the term out doesn't fix the fundamental or the root problem of having a very big shortage when it comes to houses in general. Also a big risk of boosting demand, making people, again, giving them the ability to buy it without having any more supply. This could push home prices even higher than we're seeing and really defeat the entire purpose of the affordability or doing that 50-year loan. And of course, there's going to be a lot of regulations. There's going to be a lot of hurdles. U.S. mortgage law, mainly backed government loans, are limited to 30 years. 50 years would mean we'd have to see some legislative change and, of course, regulatory change in there. Increased risk to a borrower as well. Very slow equity builds much longer term means less flexibility. If you want to move, if you want to refinance, if you want to sell, you could possibly even be underwater depending on where the housing market goes and where the price of these houses go. If a life circumstance should change, we're talking job loss, health issues, death in the family, interest rate spikes, you might be stuck carrying that larger balance for decades. And of course, we may shift to different lenders or really developers rather than buyers in the entirety. This is where a lot of the argument comes in when we're seeing all of these condo communities or all of these individual homes that are being built that are just for rentals only. They do not have the home ownership and you don't have an option to buy them. We are seeing a lot of those even in my area that they are popping up with just the ability to rent the place itself. So what exactly does it mean for you guys? The 50-year mortgage could sound like a very helpful tool, lowering that monthly payment, making home ownership more accessible, but the devil is really in the details. When you start looking at a slower equity growth, much higher in really interest costs over the life of the loan, debt horizon is going to extend to 50 years, and the risk doesn't fix the deep affordable issue that we have and the supply with the houses. If you're a buyer thinking of such loan, really treat it with caution. Don't do this without going through. There's no free lunch. There's no bridge loan. You have to know and make sure. Me personally, as a financial content creator, do you let the lower payment really blind you to what you're getting into? What am I really paying for? If you're going to a 50-year mortgage, chances are you can't afford the home that you're going into. Might even want to downsize before you even get in and really go ahead and run that. So of course, I encourage you to run all the numbers yourself, compare the terms, talk to someone who is a mortgage consultant or a mortgage loan officer. The policy ideas really grab headlines, as you can see, but home buyers need to look at the fundamentals that we see. So thank you guys for tuning in. If you found it helpful, please like the video, subscribe to the channel for more really investing insights and really financial deep dives. Drop a comment. Would you consider a 50-year mortgage? Why or why not? And I'll catch you in the next one.